So the key feature for us this quarter was phenomenal earnings growth. What we saw was very strong Q2 earnings growth, but market response was actually quite muted. And we think it could be that investors are starting to price in a potential peak growth and a potential peak in margins. If we look at the S&P 500, 88% of the companies beat, and Q2 year-over-year earnings growth was 96%, led by industrials off extremely depressed lockdown levels Q2 of last year. Canada also had a very strong quarter. Overall earnings growth, 126% up year-over-year. Energy led the way, followed very closely by consumer cyclicals. 54% of TSX companies beat expectations. But in the midst of these strong earnings reports, almost every single company talked about input price inflation and or supply chain disruptions during the quarter. Many seemed to be able to pass through these inflationary pressures to consumers, and some had inventory they were able to work through to deal with supply chain disruptions. But we do worry that these pressures may start hitting margins in the upcoming earnings, so we'll be watching Q3 very closely. On the other hand, though, corporate balance sheets are very strong. A lot of companies took advantage of low financing costs to either refi more expensive debt or just build up their cash buffer. With economies reopening, companies are actually having a tough time finding workers, which means wages are going up, positive for workers and consumption, but again, it might contribute to stickier inflation. Last, but not a near-term thing, more something to keep in the horizon, is potential increases in corporate taxes that might be a headwind to earnings in the US. Second, econ data. Again, econ data still continues to be relatively good, but you are definitely seeing signs of softness, a little bit more noise, partly due to Delta. It could also be due to we've just come off a very sharp rebound, a V-shaped rebound, and now we're starting to normalize. Last is bond yields. US and Canadian bond yields basically did a round trip. Ended up the quarter almost at the same level as the start of the quarter after declining almost 30 basis points to a near-term low on August 3rd. And what this really reflects is, again, the evolving expectations of what we are thinking about the Fed taper and also central bank accommodation, because we continue to see a tug-of-war between inflationary pressures and still relatively elevated unemployment numbers. So the key risk we're watching really is the central banks. So Fed watch continues as we get closer and closer to the potential start of taper. And you're seeing that in the bond markets. US bond yields have started moving up again, so as inflation remains elevated. So now, there's more of a discussion that perhaps it's transitory for longer, which might necessitate a response from the central bank. The European Central Bank has announced it will moderately slow bond purchases in Q4, but President Lagarde insists that this isn't the start of taper. And so far, their communication seems to have worked, and she appears to have achieved a non-taper taper, appeasing both the hawks and the doves. I've been reading a lot about China in the headlines, and the uncertainty there is weighing a little bit on EM assets, in part because China is the largest weight in the index. They're also a very important trading partner to parts of EM Asia, and they're a big consumer of commodities. And there are quite a number of EM countries that are commodity producers, and that's a big part of their economy. Starting with Evergrande, which is the most recent focus of global investors, we do not believe Evergrande is China's Lehman moment, but there might be implications on China's near-term growth because of the importance of housing and property in the economy. So as the government's focusing on deleveraging and right-sizing the property sector, you might see a bit of a slowdown in that activity and kind of the transmission to the rest of the Chinese economy. So even though it's not a Lehman moment per se, you could see a bit of global transmission because of this potential of the slowdown in China's economy to its trading partners and potentially weighing on commodity prices as well. We're also seeing news on this continuing regulatory overhaul towards the goal of common prosperity. Short term, there is uncertainty. There's a potential hit on growth in affected sectors, but we think it's a longer term positive for more equitable and sustainable economic growth. Last but not least is US-China tensions continuing to simmer on and off in the background. But really, this is the new reality. Both President Xi and President Biden have emphasized there is no interest in the new Cold War or direct military conflict at the most recent UN General Assembly. And in fact, both leaders have identified multiple venues of needed cooperation, especially around climate change. In terms of outlook for the rest of the year, as we've been saying for a little while now, overall, we do believe that the sharp initial V-shaped recovery as economies reopen of a unprecedented lockdown is likely behind us. Emerging variants due in part to the still low levels of vaccinations in many parts of the world means that we might continue to experience an ebb and flow in economic activity corresponding with virus wavelets, similar to what we're currently experiencing with Delta. At the same time, equity valuations are extended and so might be under a little pressure if interest rates and yields gradually climb as the pace of monetary expansion slows. But we still see opportunities. The global economy continues to reopen and normalize, so we're focused on quality and seeking out opportunities with relatively attractive risk reward.